Welcome back, everyone, to How to Make $700,000 a Year, Part 2 as a CFO. My name is Nelson Alvarez. I'm a CPA and Executive Management Consultant. This is Part 2 of a 3-part training series. And if you haven't watched the first 2 parts yet, I strongly suggest you go back and watch them because a lot of the stuff I'm going to say here probably won't make sense. And I also don't want to repeat myself out of respect for your time. In this video, we will focus our discussion on finishing up rule number 1 of cooking the books. In the last video, we discussed revenue. This time, we're going to discuss how the costs are cooked. Costs, just like revenue, have to be cooked and manipulated due to the inherent subjectivity of the U.S. Generally Accepted Accounting Principles, or GAAP. I don't make this stuff up, it's just the way it is. So here we go, diving right in. We're going to finish up discussion on rule number 1, cooking the books, this time looking at the cost side of the equation. We're going to dive right into an example of how the costs can be cooked, why they have to be cooked, and then finally, at the end, we're going to show how you as a CFO are going to set up an automatic system or process to ensure this is all being done for you appropriately and reasonably so you don't have to be involved in the day-to-day accounting operations. So let's start with an example to show just how costs are cooked. I want you to take a look at these 2 examples of the very basic income statement of example company Rock Solid Mining. Example 1 was compiled by an amateur CFO. But example 2 was compiled by a highly experienced veteran CFO who understands the rules of GAAP. In both instances, the company had $10 million of gross profit for the year. Additionally, the only operating expenses the company had during the year were a $1 million website it had constructed and built, and a $2 million marketing campaign it decided to run. Now, if there were no other operating expenses during the year, and we know exactly how much the website and the marketing campaign cost, why does the example 2 CFO show a higher profit than example 1? Why are their marketing campaign and website costs different? Well, the CFO of example company number 2 argued that in fact the website and the marketing campaign were considered quasi-assets. As such, they can be capitalized and their cost can be spread out over several years because that cost is expected to bring a large economic benefit, okay? That is something you can do with these, what I call quasi-assets, okay? It's a way to take large expenses, like the marketing campaign, like the website, and say, you know what, they're gonna bring a lot of benefit, a lot of business for us, so we can spread that cost out over several years. Totally legal, totally reasonable to do, and it's actually in accordance with GAAP, so you'd be a fool not to take advantage of this, okay? This is why CFO number 2's operating profit is just so much higher than number 1, okay? He took advantage of that accounting tactic known as capitalization. Now, what do I want you to take away from those cost examples we talked about of spreading it over several years? I want you to understand that if management can make a reasonable argument that X large cost will provide some economic benefit, that it should be spread out over several years, okay? It's all about reasonability, which is what you have to have your management team conclude on, okay? Totally legal, totally reasonable to do within the confines of GAAP. Now, to really show a juxtaposition, let me share a real-life example of an unreasonable cost-spreading decision that was made by a company called Waste Management that was involved in an extremely large accounting fraud in the 90s. So Waste Management is basically a trash company, okay? It owned hundreds of millions of dollars of dump trucks and garbage bins. And they would legally and reasonably depreciate those assets over 7 years, okay? Which was industry standard at the time for, garbage trucks and trash bins, okay? So they're doing everything by the book. Now, I don't know the exact number, but their assets valued in the hundreds of millions of dollars, okay? So you take $100 million of trash equipment, divide it by 7 years, we'll just say on average, and you get about $15 million of depreciation expense that it was booking. Well, the CEO wanted to increase profits, even though sales were stagnant. So he asked the CFO to come up with a clever solution. Well, the first thing the CFO did was take a look at depreciation expense. It's an easy target. He said it's too high, okay? We should be lowering depreciation expense. So what they decided to do was to increase the useful life of all their dump trucks and garbage bins by another 6 to 7 years in some cases, okay? They technically doubled the life of their assets, okay? Why is this a problem? It's a problem because every other competitor in the industry kept their 6 to 7 year useful life, okay? Waste Management decided to double its useful life, okay? By doing that, they cut their depreciation expense in half, basically overnight, okay? They took it from 15 to 7 million, okay? And they essentially booked that savings to profit, okay? So they arbitrarily and actually illegally booked that profit on their books. It was deemed illegal because it was really unreasonable, and Wall Street had thought the company was trying to deceive investors, okay? Because essentially it made an unreasonable decision to double its useful life And that's not what anyone else in the industry was doing. Okay? The squeaky wheel gets the grease. Okay? This is why I really preach to you to make reasonable decisions when it comes to spreading out costs. Okay? Management has a lot of discretion what it chooses to do with the costs. So you got to be reasonable. Look at what your competitor's doing. Look at what's industry standard, and you're going to be okay when you cook them. So really, that's it for rule number 1, cooking the books. Okay? We discussed number 1, how to cook the revenue in the first video. And we basically just finished up how to cook the cost in this second video. All right. So at this point, I just want to pause and take a step back and ask the fundamental question, why? Why do we want to reasonably cook the books to make sure we're capturing as much revenue as possible? Why do we want to spread costs out to make sure they're even so we can record as much profit as possible? Okay. The answer is simply, that is what Wall Street expects. Now let me explain. And this is touching on rule number 3 right now. What Wall Street expects is consistent and reasonable results over the long term. It doesn't like short-term spikes, okay? This is why reasonability and consistency are key when it comes to reporting your financial results to the market. Now, that may seem obvious to a lot of you, but you would be surprised at how many CFOs just do not do this. There are CFOs out there that make it their mission to blow away and exceed analyst expectations almost quarterly. And a lot of the times, the ones that are doing this are just trying to get rich quick at the company's expense. They want to jack up the stock price as fast as possible by bending the accounting rules a bit too much, and then is jumping ship with a golden parachute while the company crumbles behind them. Now, some of you out there may say, wait a minute, Nelson, I've seen plenty of instances where a company reports better than expected results and blows analyst expectations, and the stock price goes up, and it continues that way for such a long time. So how can you say that the market doesn't want us to exceed expectations? Well, you're not wrong, but here's the thing. Okay? You're totally right that when a company exceeds analyst expectations or has a blowout quarter, its stock price jumps immediately, okay? But the thing is that the analysts in the market have very little reason not to trust the numbers. Why? Because those figures are audited and vetted. As such, the market assumes they must be real because they have no other data to disprove those numbers. You have to understand that it takes months. It can sometimes take years for the market to officially comb through all the data from your customers, from your suppliers, from your competitors, okay? It can take that long for the market to officially say, yes, the results you reported 2 years ago are in fact factual and accurate, okay? If there's no other competing data or information, the market is going to assume your results are accurate because they've been audited, okay? This is why it can take years for accounting scandals to come to the public light, because the market needs more data to essentially validate your results. Similar to like a blockchain would work, right? You should also know that there are firms out there on Wall Street that specialize in the scrutiny and investigation of companies that report unreasonable results compared to industry norms, okay? What they do is they investigate and they let it be known that we think X company has inflated its profits because of Y, okay? It's showing unreasonable something compared to the industry. These firms are smart. They do the math. This is how firms get taken down. WorldCom, Enron, and Waste Management all got hammered because of this, because of their unreasonable accounting management decisions. Don't let your reputation get ruined. Make sure you're making those reasonable accounting decisions. I quickly want to end this lesson with a discussion of rule number 3, which is knowing how the corporate finance game is played. Wall Street rewards companies that show steady, reasonable, and consistent increases in profit over time, not overnight. Unless it's real. If you legitimately doubled your revenue overnight, nothing wrong with reporting that. Go ahead. My lesson was geared more towards keeping you out of accounting trouble by reporting unreasonable results, okay? This is why you have to check with consultants. We got to check with your internal accounting team to make sure what you're doing is reasonable and appropriate. But by applying rule number 2 of asking questions and gathering data, you will naturally be applying rule number 1 of reasonably and consistently cooking the books, and then automatically following rule number 3 of meeting market expectations, okay? It's a beautiful, harmonious cycle, okay? If you ask questions, you'll get the data, you'll make the right decisions. If you demonstrate those 3 rules and the harmony that exists between them in an interview, I see no reason why you can't get that job. In the next training session, we're going to highlight those areas on your financial statement that analysts want to see, okay? Based on your industry, some want to see a gross profit margin that's X%. Some want to see an operating profit margin that's Y%, okay? That's what the final lesson is going to be, how to essentially cook your classifications to hit that target profit that the analysts and market want to see, okay? So I'll see you in the next video.